Okay, when we last left off, we were talking about bankruptcy. Now I want to talk about credit and suretyship, and they are related. They're related topics. Credit is important. Why? Because, well, quite frankly, that's how much of business gets done. And we all know what happens when credit, quote, got tight, and we had the financial crisis a couple of years ago. Businesses really struggled, and to some extent, they continue to struggle today. Now, credit. Now, credit is basically someone loaning you money. Now, they can loan you money in one way or another, two ways, either in an unsecured or secured way. Well, let's talk about the unsecured first. Unsecured credit means that the party that has lent you the money, they are just relying upon your good faith and credit to repay that loan. They're relying upon basically your credit score. And that's it, just your credit score and your reputation. That's when money is lent on an unsecured basis. Money can also be lent on a secured basis. Now, what does that mean? That means that the party that has lent you the money, usually the creditor, usually a bank, they have some kind of collateral. Now, we've all heard that term before, collateral. Well, what does that actually mean? Well, what that means is that the creditor has a lien against that collateral. Now, collateral in business could be things like accounts receivable, it could be inventory, it could be real property. It could also be a guarantee. That's a suretyship, when someone else guarantees the payment of the loan, kind of like a co-signer, if you will. That's one type of suretyship. So that's when credit is extended on a secured basis. Now, what does that mean, secured? That means that the creditor, they have a lien. A lien is a legal right to seize collateral if the debtor cannot repay the loan. So I'm going to talk about two types. I'm going to talk about secure transactions in real property, real estate, and secure transactions in personal property. Now, with secure transaction in real estate, they're probably one of the most common forms of secure transactions. The most common type is a mortgage. Now, what is a mortgage? A mortgage is a two-party instrument. You have the owner-debtor, called the mortgagor, and you have the creditor, who is referred to as the mortgagee. Now, the creditor is usually a bank. So if you go out and you buy a home, the bank agrees to loan you money. Now, oftentimes it's stated at the end of the loan, people are in a celebratory mood, and they say, the mortgage is paid off. You know, we own the home. Well, actually, that's not true. The mortgage is actually not the loan document. The loan document is the note. There is a note that sets out the mortgage, the payments, the mortgage payments, the note payments really, they're not mortgages. The mortgage, that's the legal document that gives the bank a secured interest in that real property, so that if you don't pay your mortgage, what can happen? Well, if you don't pay your mortgage, the bank can ultimately seize the home to make the mortgage payments, to pay, to sell it, and to satisfy that loan. So when people actually say they paid off their mortgage, what they've said is they paid off the note. Well, what about the idea of we paid off the mortgage, we own the home? Well, actually, the debtor, the debtor, they are actually the owner of the home. They are the title interest in the home. The bank does not own it. They may have there may be a loan. They may have lent you money to buy the home, but they don't have ownership interest in that home. What they have is just that lien. They have a lien that's expressed in the mortgage. So it's a two-party transaction. The debtor has a right to possession so long as they comply with the terms of the note to continue to pay off that loan. All right, now there's also a three-party transaction. Now, New York is a mortgage state. Banks, when they loan you money, they do not own your property. You own the property. They just have a lien. Some states, however, follows a note and deeds of trust system. Now, that's a three party transaction. You have the borrower, trustor, you have the lender, creditor, beneficiary, and then you have the trustee. Now, the note, it's an instrument. There are a couple of different documents here. You have a note and you have a deed of trust. The note, that evidences the borrower's debt to the lender, creditor, beneficiary. So you have a note, just like in the mortgage system, you have a note. Now you have a deed of trust. Now that deed of trust, what that does is it gives the creditor a secured interest in that property. But it also places title ownership not in the debtor trustor. It places title ownership in a trustee, usually some kind of corporation. And what happens is the trustee holds that property. The debtor trustor, they have a right to possess the property, but they do not own the property. The trustee owns the property. And the lender, creditor, beneficiary, the trustee, holds the property for the benefit of the lender, creditor. If for instance, the borrower, trustor, should stop making payments, then ultimately the trustee can transfer ownership back to the lender creditor. So there's three parties involved. The difference is the big difference is that the trustee actually owns the property until the note is paid off. Now, we've talked about recording statutes before when we covered real estate. And most states require that the note, the mortgage, a deed of trust, okay, and anything else, any other papers associated with it, must be filed with the appropriate county clerk's office. Okay. And again, the whole point of recording your interest is what? Sorry, my cat's there. The whole point of recording your interest is what? To put the world on notice that you have this interest in the property. And the same holds true for other types of liens. There are mechanics liens that we talked about before, tax liens and judgments. All of those have to be filed. All right, so what happens if you fail to make a payment under the terms of the note? Well, two things can happen. One, the mortgagee, the creditor mortgagee, if it's depending on the state, they could bring a foreclosure action. Now, if the mortgagor defaults on the mortgagee can declare the entire debt payable immediately and then bring a lawsuit to seize the property, bring a lawsuit to exercise their lien. Now, other states, particularly in the South, usually in the mortgage, there is a power of sale provision, wherein the creditor, the lender, does not need to bring a lawsuit. They can go right to the sale. They can just schedule a sale with an auction and sell the property. They don't have to bring a lawsuit. If there's any issues, any legal issues, then the borrower or trustor, well, they can bring a lawsuit after the fact. So that's basically how liens are exercised. Okay. Now, those are secured interest in real property. I want to talk about secured interest in personal property. Now, personal, they are governed by Article 9 of the UCC, and there are two types of transactions. Again, a two- and a three-party transaction that are very common in business. The two-party transaction, you have a buyer, a debtor, and you have a seller, a lender, a secured party. The seller-lender sells goods or equipment to the buyer-debtor on credit. And in return, the buyer-debtor gives the seller-lender a secured interest in the goods. So, for instance, if you go to a car dealership and you purchase a car, well, the dealership may offer you financing. That's a classic two-party transaction. Now, the second type of transaction for personal property, so it's very similar to a mortgage. The second type is a three-party transaction. Now here it gets very different from anything we've done before. We have a seller, and the seller sells the goods to the buyer. And the buyer, they pay with a loan that they have obtained from a third party, from a lender. So instead of, for instance, going to the car dealership to get financing, you go to where? A bank instead. So that's a three-party transaction. So you have the seller, and they sell goods to the buyer, and the buyer secures financing how? From a third party, usually some kind of creditor. In both instances, there is a security interest in that property. Whatever it is, the goods that are being provided, it could be consumer goods, equipment, farm product, or inventory. It could be accounts receivable or other kinds of intangible properties like patents and copyrights, etc. Now, suppose you are a creditor in either a two or a three-party transaction. Okay. Well, just like being a creditor when someone buys a home at the bank, you also have to perfect your interest. Just like a mortgage, you have to file paperwork with the state. Except it's not called a mortgage, it's not called a note. You have to file what's referred to as a financing statement, usually with a state government agency of one kind or another. Now, the financing statement is covered by the UCC, Article 9, and it requires the following. The financing statement has to have 1, the debtor's name and mailing address. 2, the name and address of the secured party from whom information concerning the debt, the security interest, can be obtained. And 3, a statement indicating what the collateral is or a description of it. Now, I don't know if you remember this when we covered real estate. You have condos and co-ops. With a condo, you get a mortgage, you get notes, you get a deed. Okay, those are all filed with the county clerk. With a co-op, right, that's technically, even though you would say you're buying an apartment, you're really buying shares of property. With a co-op, you have to file a UCC financing statement. So there is a difference between the two. All right, so that's the case in most instances. You have to file a financing statement. But there are some exceptions to that. For instance, consumer goods. When you purchase consumer goods in the course, and those are basically final goods to consumers, they don't have to, the seller, the creditor, doesn't have to file a lien. So if consumer goods sold to consumers, they don't have to file a lien. That's an exception to it. Okay. Now, once the debt is paid off, the secured party must file a termination statement. Okay. Now, what's a surety and what's a guarantee? Well, a surety, okay, a surety and a guarantee or guarantee arrangement, that's when a person has vouched that you will repay the loan. In common parlance, perhaps you can refer to them as a cosigner. Now, I'm not going to spend too much time on it, but a surety is a person who acts as a cosigner. And the surety, they are equally liable for the debt. So if someone signs as a surety, you sign to purchase a car, and someone else signs as a surety, you are both equally liable for the debt. Okay? The lender does not have to wait until they have exhausted all of their remedies against the primary signer. They can go after the co-signer right away as well. A guarantee arrangement is a little bit different. The guarantor is secondarily liable. So they are only liable after the creditor has exhausted all of his remedies against the primary signer. So that's just the difference between the two. All right. Keep up with this work, take good notes, and if you have any questions, please email.